I'm Joel Faley, and I'm chair of accountancy here at ETSU. I'm going to have 4 short videos here to sort of introduce you to the accounting course that you're going to be taking in your MBA program here at ETSU. The first one's going to be pretty much an overview of what to expect in this course. The second video will be about financial accounting. The third video about managerial accounting, and then the fourth video is going to be about generally accepted accounting principles, also known as GAAP, which is really the essence of what this course is going to be when you take accounting 5150 information or accounting information for decision making. So first of all, just to sort of give you an idea of what's in store for you in this accounting course. You only have one accounting course out of the 12 MBA classes that are required to get your MBA degree. So it's a pretty high level class. I've really focused on case studies. There are 7 of those that you're going to be writing papers on, and each one's about 1,500 words where you'll have to do some research and answer some questions. And each of those 7 cases revolve around a particular company, some that are engaging in some fraudulent activity, and there is a gap, or there's a generally accepted accounting principle involved in each one. Like the first one is about WorldCom, where we'll look at revenue recognition. The second one is about waste management and expense recognition, and on and on. I'll get to more of that when we do that particular video. First of all, just overall, when we look at this accounting class, we're going to talk about debits and credits, which I've got a textbook here that is very cheap. It's only cost about $5. Got another text as well, which again is probably about $5. And both of these texts are for $10. It tells you pretty much everything you need to know about accounting. Now, I worked in business for about 33 years or more before I came into academia full time. I'm a professor of practice, which that's my specialty, being able to take the theory and put that to practice, the practical application of the various theory that you learn. So these 2 books really aren't textbooks. They're really books to help you understand accounting more. So I didn't want this to be a rehash of principles that you had in undergrad. If in fact you have a business background. So this is really starting at ground zero, but we're going to build on that very quickly to where you understand what is necessary in order to be a manager, to be a financial leader, or be a general manager of the businesses that you work for. But we're going to start with just financial accounting and what we know as debits and credits, and the accounting cycle or the accounting equation, and double entry accounting system. Now, I want to share a screen here with you that has on one page really the essence of what accounting is. Should be able to see that now. And what this is, I call it accounting concepts. And you see at the top income statement, you see balance sheet, and then at the bottom or the next page, statement of cash flows. And obviously, statement of cash flows has very little information associated with that. That's because the 2 primary statements that accountants use, and not just accountants, it's accountants prepare those, and finance people use, as well as all facets of business, whether it's a general manager or whatever field you might find yourself in, or discipline you find yourself in. You need to understand an income statement and a balance sheet. You may have that at the department level. When we talk about income statement, it may be at the plant level or distribution level, maybe at the corporate level or division level. But income statements are critical that you understand. And when we talk about an income statement, it is for a period of time. And that's why I have that stated there, period of time statement. The accounts on here are temporary, because when we start talking about accounts, a chart of accounts that a business uses is made up of 5 different account types. Two of them are income statement, which are revenues and expenses. You got revenue accounts, you got expense accounts. And then the balance sheet, the second statement on this page, is for a point in time. And those accounts are permanent and never get zeroed out. You say, well, why do you zero out income statement accounts? They're temporary. That's why you zero those out, and they get closed to what's called income summary, which ultimately gets close to retained earnings, which is a balance sheet account. So retained earnings is the link between your income statement and your balance sheet. Now, what I have on here is what's called T accounts. You can see the T there for under revenue, the normal balance. And some things you just have to take for granted. And one of those is that the normal balance for revenue is a credit. The normal balance for expense is a debit. So it stands to reason if I have more credit than I have debit in these two accounts, then I've got what? I've got a gain. I've got more credit. So I'm gonna have a credit balance that goes to my balance sheet as equity right here. So it flows down to the equity on the balance sheet. And you say, well, why is it credit and this is debit? Well, it's just like saying, well, why does stuff fall to the floor when I drop it? Well, it's because of gravity. And you just have to assume that when you look at expenses and revenue, what the normal balance is. Doesn't mean you can't make a journal entry or something that goes against the opposite balance. That's normally what happens when you close those accounts out. But let's look at the balance sheet there. So it is a point in time. When you say period of time, that means maybe for a month, a quarter, or a year is a period of time. How much income did you make during the year? It's kind of like what you get with your W-2 statement at the end of the year. What's your income for the year? What's your revenue? And your income statement would, or your W-2 would tell you what your revenue is for the year. And then if you looked at your checkbook or your credit card statements or whatever you're using to pay funds out of, those would be your expenses. So if you got more revenue than you got expenses, then, or your W-2 is higher than your checkbook, then obviously you're making money, right? That's net income from a personal standpoint. So that's an income statement. What's a balance sheet? That's what you have to have whenever you get a loan. Maybe it's for a car, maybe it's for a home. You say, well, I've never had a balance sheet, even though I've got a home loan. Well, I guarantee you, whoever you got the loan from, they put a balance sheet together for you because they want to know what is your debt. And debt is another word for liabilities. What is your debt in relation to your assets? Assets are what you possess. Your liabilities are what you owe. Your equity is what you own, right? What you possess, you might have a $100,000 house that you owe $80,000 on. So you got a $100,000 debit. You got a credit for $80,000 what you owe, and your equity is $20,000. That's what you own, right? As you pay that debt down, liabilities, ultimately, your assets and your net worth are going to be the same, or your equity is going to be the same, right? So you may think, I don't have a balance sheet. You do have a balance sheet. And if you don't put one together, whoever you're getting a loan from will do it for you. All right, so when I talked about temporary and permanent accounts, there are basically 5 types of accounts: and revenue, expense, asset, liabilities, and equity. You may have a chart of accounts for 10,000 different accounts, but they fall under one of those 5. Always keep that in mind. So that's the essence of what goes on with an income statement and a balance sheet. And you think, well, when you look at expenses, it's got a debit and assets have a debit balance. That sounds kind of weird, doesn't it? But in reality, think about what an asset is. An asset is an unexpired cost, right? When we hear the word cost, that is actually an asset. You may think a cost is something that's an expense. Well, it is once you actually use it. But think in terms of if I bought a piece of equipment in my business, maybe I own a construction business and I buy a bulldozer. That bulldozer goes on my books as an asset, regardless of whether I paid cash for it or it's debt. But that asset, that bulldozer, is going to be depreciated. It's going to have that cost of a bulldozer, which is an asset, allocated over its useful life to depreciation expense. So the asset value goes down as I drive revenue with that asset. But where does that depreciation expense go? Well, you're crediting your asset through accumulated depreciation, and the expense goes up here because double entry accounting. It's a term you'll hear a lot. Double entry accounting says that debits and credits must be equal. Debits must always equal to credits. So if I'm crediting accumulated depreciation, I'm debiting depreciation expense, I, in essence, am writing off that asset as I use it to go against my revenue. So we recognize revenue, we match the expense with it. That usually comes from an asset. Doesn't have to come from an asset. It may be something you directly expense as you incur that. That's something else we'll get into later. So keep that in mind. And, you know, a lot of people think, well, I was never really good in math in high school or college. That's why I can't understand accounting. Well, I can tell you the math in accounting is pretty simple. The only difficult part, if you want to call it difficult, is algebra that you encounter here with the balance sheet. So you got assets equal to liabilities plus equity. So what did you learn in algebra when you were in middle school or high school? Cross the equal sign, the opposite is true, right? The sign changes. What's a negative on one side becomes a positive on the other. Same is true here. If we're trying to say what is our equity, what if we move liabilities across the balance sheet to here? What if we move the equal sign right there between liabilities and equity? Assets minus liabilities is equal to equity or net worth. You know, people talk about, well, what's your net worth? Your net worth or equity is assets, what you possess, minus liabilities, what you owe, right? So think about it. If I have a normal debit balance of a debit for an asset, then if I go across the equal sign, the normal balance has to be a credit for liability and a credit for equity. It has to be, right? And then we ask, well, this expense and asset, we just sort of talked about that. Those are sort of like siblings. If an asset is an unexpired cost, when it comes off my books, it becomes an expense, right? So you're crediting the asset through accumulated depreciation, and the expense shows up here on the income statement. See how cool that is? So that's about as difficult as math as you get into it. And I want you to know that. Maybe it's something that maybe some lights have turned on in some people's minds from what they had in Principles of Accounting, or if you've never had accounting before. But that's why I had that book, Accounting Made Simple, that you should read. It takes every bit of an hour to read through that, maybe 2 hours if you want to stop and try to understand everything that's in there. But that book that I have here, it's outstanding. It's written by a CPA. It's only 100 pages, very thin, very easy to read. So you need to read that before you take this class, which is Accounting 5150. In fact, you need to read this in order to take this self-test that you're going to have at the end of this boot camp. All right, so what else are we going to talk about? Let's see. Let me share something else here in this opening overview. Let's see, let's share. The accounting principles here we're going to get into in a later video. The accounting cycle, hopefully you can see that. This is in the content of the D2L for 5150. And this is the cycle that accountants go through. I don't know that you necessarily need to know this at this level as an MBA student, but it doesn't hurt to see what the accounting function does about identifying transactions, recording those journal entries, the debits and credits, posting to the ledger, which is where you keep up with all your account balances. And these trial balances, the closing process generates these financial statements, the income statement, the balance sheet, and of course, then we do the cash flow statement. Then books are closed, meaning we zero out revenues and expenses, and then we start the whole process again. Most companies do this on a monthly basis. I've never worked for a company that didn't. Quarterly is even more important because if you're publicly traded, meaning that you have to follow the SEC guidelines for reporting. They look at quarterly, they don't look at monthly, they look at quarterly, and of course the annual, very important because that's normally what's going to be audited by your external auditors, which is important. So that's basically the accounting cycle. GAAP, which we're going to have a separate video on, but here, what I'm showing here in the content, GAAP Quick Facts, again, that stands for General Accepted Accounting Principles. It's a rule book companies follow, and very important. There's 12 of these guidelines, assumptions. FASB, Financial Accounting Standards Board, issues those. They get a lot of input from other organizations like AICPA, CASO, probably even the IMA, which is Managerial Accounting or Management Accounting. And who's required to follow this? Publicly traded companies. And the SEC, Securities Exchange Commission, they're the ones that enforce FASB. They're the ones that enforce GAAP, which is promulgated by FASB. So they enforce that. That's why when we look at these 7 cases related to these GAAP principles, you're going to see how important it is that people follow this, or else you're personally liable and can go to jail. And we'll see that, or go to prison. We'll see that in several of these examples. Another concept that we'll look at here in the next video in financial accounting has to do with accrual basis accounting. You know, there's cash basis and there's accrual basis. You still use the same accounts. It's just accrual basis says you have to recognize the revenue when it is earned, and you match the expenses with that. That's the accrual basis. The cash basis says you only recognize revenue or expense when cash actually goes out the door. But most businesses allow accounts receivable and accounts payable. And so accrual basis of accounting, ACCT is very important. We'll be hitting on that as well. So that's sort of a brief overview of the accounting boot camp that you're taking here at ETSU. Get a lot of positive feedback because it's a little bit different accounting course than you probably have had in the past. And if you've never had an accounting course, then you are in for an intriguing course that may that will help you a lot in your career. I oftentimes tell my students that you need 2 things to be successful. You need to have knowledge of the numbers in business, because businesses are run based on numbers. It's all about earnings per share and everything that drives that. And the second part of that is working on your relational skills, your human skills. So you need the technical background of understanding the numbers to be successful, how to manage a business, how to manage a budget, but you need the human side of that, relational skills of being able to motivate by delegating and motivating people, the soft skills. Sometimes financial people struggle with that. But you need those 2 things, and really to move up to the upper echelons of a company, you need the conceptual skills, which come usually later on in your career, having a good systems understanding of what is taking place. So enjoy talking with you, and I'll see you here in the next video.